This panel is a new topic for us, and I think it's extremely pertinent. We're talking about hedging away from big tech and the monster rally we've had in FANG MT, which doesn't roll off the tongue like FANG, but still quite a massive concentrated bubble here. So I'm going to hand over to Roy. He's going to be our discussion leader, keep us on task here. And thank you, panelists. Have at it.
Welcome, everyone. It's a pleasure to be part of this. I think I'm just going to start off by showing what we're dealing with here. I think you can you see this? This is a chart of the FANG index since 2017. So you can really see what's gone on here. Just enormous returns. We've just had this big drawdown, but I think what everyone is concerned about is, given portfolios that tend to get concentrated in these stocks and in NASDAQ exposure and tech exposure, what do we do? Are there some overarching risk factors? What are the ways of hedging this out using other equity strategies? And are there additional asset classes and or strategies that can really serve as a protection? So I hope that we'll have a lot to talk about. And I think perhaps we could just get going by hearing whether, just maybe a recap of each person's strategy and whether you have some exposure to this trade or the volatility that seems to be derived from this, this sector. Can we unmute?
I can start. This is Catherine. So we are a $1.5 billion public pension plan. We're one of 3 different retirement systems at Fairfax County Retirement. So collectively, the 3 systems have about close to $7 billion in assets. I would say that we don't have nearly enough exposure to what you're showing us, or at least I would say that up to now. Although in the last couple of weeks, I'm probably a little bit happier about that actually. But in general, we don't have an enormous exposure to tech, and we have hopefully much more broadly constructed portfolios. I would even kind of take it a step further, and I would actually not only label this tech, but just exposure to growth assets and to rising growth. And in general, that would be equities, but it's not only directly equities, it's a lot of other things like credit and things of that nature. So things that really are levered to a rising growth environment. And we really go out of our way to build portfolios that that can do well in that environment, but it can do well when you have other environments. So when you have falling growth and, peak, trough, recession, that type of thing. So we definitely had some exposure, but we are have not been kind of all in, which is unfortunate the last few years, to be honest. But.
Hi. Sorry, this is Neil Berger.
Oh, Neil.
Hi, Roy. Nice to see you.
Nice to see you, likewise.
Thank you, and thank you, James. So I'm the founder and president of Eagles View Capital Management. Sorry for the lighting. I'm not sure if you can see me here. I'm not in my normal space. But Eagles View, well, I've been in the business 30 years. I've been investing in hedge funds for 25 years. Fortunately or unfortunately, Eagles View has been around for 15 years, but our mandate from day one has been to invest in strategies that don't correlate to the overall direction of anything, whether it's the direction of equities, fixed income, commodities. And we do that by investing in niche-oriented, often capacity-constrained strategies that focus on a specific inefficiency in the market. So we're completely non-directional in nature. Examples would be congestion trading across the electricity grid, or inefficiencies in forward freight arrangements in the shipping derivatives market. We're the largest investor in the world in Muddy Waters, the famous research activist Carson Block. We do everything from U.S. new issue or global new issues trading, IPOs, secondaries, blocks. So we don't, our product has been created to sort of act, I suppose today, we have nothing to do with bonds, but in a world where there's no, the 60-40 model, there really is no 40, there's trillions of dollars in money market funds. There's trillions of dollars in high quality bonds that are yielding effectively zero. So we kind of cover that space for investors of providing truly non-correlated return stream, simply because I think that's what's useful. The world doesn't need another hedge fund. The world doesn't need another fund of funds. So we do it. We are technically a fund of funds, although we don't invest in any of the mainstream strategies. As far as what's gone on in tech, seen this movie before. I mean, it's we're in a bubble, plain and simple. Probably tech is symptomatic of a global liquidity bubble. Everything in the world is expensive. Maybe it's being expressed more aggressively in the technology stocks, but with the world awash in liquidity, I'm old enough to have been in the business now for over 30 years, so I remember the late 90s, which is the only sort of comparable I can think of to what's going on today. Anything with the .com after it, would raise money automatically and go through the roof. And, those bubbles end. When it ends, how it ends, we're not in the prediction business. We're not smart enough to predict that. When things are 20 times overvalued, they can go to 100 times overvalued. When they're 100 times overvalued, they can go to 1,000 times overvalued. There's really no top to these things. It's just the physics of the market that's, at play. So we unfortunately have not had any exposure to FANGs or any other sort of directional exposure to any of the markets, but that's by design, really, because that's not the product that we're offering investors. We're offering investors a non-correlated return. And last year we made in our flagship product 7.5. This year we're up 7 through the mid-year with literally zero beta to the market since the inception of our firm, 15 years ago. So I think that's a decent situation, and I'll yield the floor. But that's basically what we do. So I'm not smart enough to predict where the tech stocks are going, and all I would say is that market prices and fundamental rationale is the norm. It's always supposed to be disconnected. It's probably more disconnected than it's ever been, than I've witnessed in my entire career. But being disconnected, market prices and reality of fundamentals and buying businesses are two different disciplines, and are by definition by nature disconnected as the norm rather than the exception. So I'll yield the floor to the others.
Asim?
Yeah, look, we tend not to carry a lot of equity beta in general. We trade occasionally with the long side. We tend to be more short than not when it comes to the NASDAQ or even the S&P 500. I'm not 100% sure it's a bubble. I think these stocks are very expensive. If I had to compare it to a different regime, it might be better to compare it to the Nifty 50 in the late 60s, early 70s than to the 2000 time. These are large companies, like Apple and Google, that throw off a ton of cash flow. They have earnings. They're very expensive. We all know that. And you could argue that a bubble to me is something where you have stocks like you did in the .com days that were going to go down 80, 90% when the bubble burst. These stocks might go down 20, 30, 40, and then have a trading range for 15 years where you make no money, but they still just go sideways. To me, that's not so much a bubble. It's more a sign of the times and where we are in the world. I guess I would also argue that in a world where in the US and Europe and Japan, there's very low population growth. It's below replacement rate when you think about the long-term demographics. You don't have a real case to make for value to a certain extent, because you don't have a driver for cyclicals and materials and other stocks and even the banks to turn up. And so for me, you only have 60 growth stocks in the S&P, and you have to pay up for them at the end of the day. So that's sort of the way I think about the backdrop. The other thing I think is, if there's a bubble in our industry, and this is a controversial statement, but I'll say it, the bubble in our industry is in followers and adherents of Buffett and Seth Klarman. For the past 20 years, everyone I've known in my cohort that graduated from college became a disciple of value investing, where you want to find something trading at book value or at a very low multiple. You want to buy $1 for 50 cents, and that's sort of what the Harvard and Princeton and all of those folks look for in the past 20 years. That has been arbitraged away. And just because value did better than growth for 84 of the past 100 years doesn't mean it has to do that for the next 20, 30, 40, 50 years. I actually think we're only halfway through growth outperforming, and growth may do well for the next 10, 20, 30 years. Controversial statement, but I can see a thesis for why that might hold. So I think it's a very tricky time, because I don't think there's a case to make to short these stocks. I think the best case scenario is they may go higher and then you have a trading range where they go sideways. The passive kind of crowd just gets killed by not making a good compound return for the next 10, 15 years. And then you just have to have a good portfolio that has enough other exposure to some of the stuff that's been presented today to hedge around that.
Well, it sounds like the last place to look for exposure to these stocks is this particular panel. So we're probably well versed in how to protect those who do have a lot of exposure. But I first want to ask a question about another potential driver of the valuations that we're seeing right now, which is how much of this is just the central banks printing money to save things, and what would this be like without the Fed, and what would we do if the Fed suddenly says, you know what, we're just going to let things go? What happens to FANG?
I'll just put a quick statement in. My take is not very much. I don't think it has a whole lot to do with central banks. Again, maybe controversial, but central banks follow the economy and other major pieces of the economy. In the low growth world with a ton of debt, with developed economies, again, with low population growth, you have to pay up for these growth stocks. They would be expensive no matter what. The central banks have acted, but in the absence of central banks, I think you still have the same pricing, believe it or not.
Catherine, you want to try that one?
I think I agree with Asim as it relates specifically maybe to the tech sector, but I would say if we step back and ask the same question kind of about more broadly about risk assets, I think things would look very different if we didn't have the kind of stimulus that we've had, both monetary and fiscal, and that just seems to provide a floor to virtually every risk asset. It's pretty phenomenal, actually, and with no end in sight at all.
Neil, what would you say?
I would say I disagree with Asim. I think that certainly it's not only possible, but likely that the tech stocks, even the best of them, will go down over 80%. I've seen this movie before, and the other ones won't survive. But, I mean, Tesla, I don't know, it's trading the equivalent of over 2,000. I remember when Elon Musk made his famous tweet that, taking private, money secured at $400, and now it's trading at the equivalent of over 2,000, I think, with the splits. So down 80% just brings us back to that unthinkable number of 400, just not even a year ago, or maybe a year and a half ago. So to me, it's crystal clear. We have a marginal buyer, an elephant, a multi-trillion-dollar elephant, and the demand-supply equation between buyers and sellers is very skewed in the sense that we have this marginal buyer, which is the central banks, and we literally have no sellers, because the sellers, the real money, guys that are sitting at pension funds, endowments, they're benchmark oriented. They don't care if Tesla's is expensive or Amazon is expensive. If they underperform the S&P or they underperform their benchmark or their peers, they're going to get fired. So you have a large marginal buyer. You have no sellers, not because they don't want to sell and they don't see the same crazy things that everybody else sees. It's just because they can't, because they're in the business of keeping their jobs and not figuring out whether something is cheap or expensive. And and then you get all the algos on top of it and the Robinhood guys. So you have a situation right now, because of the massive amount of liquidity that's been pumped into the system. And the only key question, which I'm not smart enough to figure out, and I don't know that anybody else is either, when does that tide of liquidity change, or when does the US dollar stop being accepted as widely as it is around the world, in that there's a willingness, the ability of the Fed or the Treasury to bail us out and provide this put below the market is predicated on the world's willingness to accept the US dollar and our continuing ability to create credit and bonds that the world will buy. To the extent that that no longer exists, or the world is full up on dollars, that's when the Fed and the central banks or the Treasury can't support us anymore. But as of right now, the US dollar is still the world's reserve currency.
What are some other risks that would hurt a concentrated equity portfolio that investors should be thinking about right now?
The risk of them going down. I don't know. I mean, the more concentrated you are, if you get it wrong, you can get it wrong in a big way. The more concentrated you are, and you're, to me, again, I would not be sitting in this seat for over 30 years if I was shorting the market. I mean, you can't short the market because that's the quickest way to the poorhouse that there is. But when this thing will end is anybody's guess. So, the more concentrated you are, the more upside there is and the more downside there is. And your risk is that somehow the physics of the market change, the dynamics change, the world stops accepting our currency as the reserve currency, and these stocks go down, and then the momentum starts to build. It's more about the physics. It's more about the, fundamental analysis is, to me, it's a completely separate discipline from making money. We're in the money-making business. We're not in the being right business. So the industry and trading and is more about physics than it is about economics, in my opinion. And so it's really the study of physics and how, the market as an organism itself, if you could think of it as a living organism, the laws of physics apply to it. And right now you have a tremendous amount of inertia that's going on because of whatever factors. I'm not smart enough to list them all, but that's my opinion.
Anyone else? Are there any fundamental factors that you could see really materially impacting either these stocks or the stock market in particular, with these stocks representing a high beta bet on the stock market?
I think, look, whether it's a bubble or not, I think I'm in agreement with Neil about the idea that these stocks are very expensive. So forget about whether they burst and go down 80% or they go down 30, 40. The big risk is if you're a passive buy and hold allocator, a pension that needs a CAGR of 7.5% to meet your obligations, you're not going to get it. And where valuations are today, you're not going to get it on a 10 to 12 year horizon. If we're still in the secular bull market and we have another 3, 4, 5 years to go and these tech stocks get even more expensive, one of the biggest risks in general for passive buy and hold, whether a financial advisor is dealing with $1 million portfolio for a client or whether it's a pension fund, is instead of having a recession and stocks go down a lot, these stocks kind of just trade sideways in big ranges. And if the valuations continue to go higher, you could get stuck and have a 2, 3, 4% CAGR staring ahead of you for 20 or 30 years, which is inconceivable because in our lifetime, the two secular bear markets we've had have been, let's call it 12 to 14 year experiences. So 68 to 82, and then you have 2000 to 2012. What if you have a secular bear market ahead of you that's a 30-year or 40-year affair? These things have happened before in financial market history. We haven't seen them happen in generations. But if passive is the bubble and if passive is the issue and everyone's gone passive and indexed, whether it's a small-time client at an Edward Jones office or a pension fund, and if you have a sideways trading range to work off extreme valuations for decades, that would be the end of it. That would be how passive dies. Instead of having a fireball supernova where there's a bear market that cleanses things, everyone stays passively invested, and for decades it just gives you a 2% CAGR instead of the 8, 9, 10% people think stocks give you.
I guess you could look at Microsoft, which was the growthiest growth stock of all for a while, and then just cratered and just stayed down for so many years. Of course, they've done a great job recently, but if you had to pay out your pension obligations during that 15-year period, it would have been a difficult time, and imagine the whole market doing that. How do you handle that risk, Catherine, and when you think about it for Fairfax?
Yeah, thank you. So I would say that's probably the one thing that probably keeps us all up at night and has for years and probably will continue to for years. So we have a 7.25% needed return target, and with zero volatility around that number. And because of how well risk assets have done in the last 5 years, 10 years, you kind of name your time frame, we really do we subscribe to the belief that that's brought a lot of future returns forward. And so our outlook at this point for the return, the excess return over cash for most risk assets is pretty moderate at best. And trying to get to 7.25, the math just almost doesn't work. And so what do you do? And so increasingly in the last 4 or 5 years, we've been increasingly taking money out of public markets, putting it to private markets. That's super crowded as well. We have a lot of company there. And then we also basically our entire portfolio is kind of one big portable alpha. I say trade sounds really negative, but it's a big portable alpha construct, if you will. And so we are passive in certain areas, and we get that exposure synthetically using managed futures, and then with the money that frees up, then we deploy that other places. So in essence, we have a modest amount of leverage in our portfolios as well, and we hope that between a modest amount of leverage and then increasingly going private, that we hope that we can get to 7.25. But it's not going to be easy.
And when you take that managed futures exposure, are you actually using your individual stock holdings as the collateral?
We have a certain amount of cash that's just set aside as a collateral, and I'm speaking about this as, again, completely passive, and then we separately have active managed futures or global macro manager or CTAs. But I'm speaking right now about the passive trades that we have through futures, and so we have a certain amount that acts as collateral. I also have TIPS that's collateralizing that, and then I hopefully have other liquidity that if I get a margin call, if I blow through all of that, that I can still make that margin call from somewhere else. So certain other pockets of liquidity.
That's one of the unknown ways to invest in futures, to actually use other securities rather than cash, and
Yes.
it does allow you effective leverage without actually borrowing or really using leverage. So your stocks do double duty, I guess you could say. I just want to call out to the audience. We have a few more minutes left. I'd love to have some questions from the audience listening. But I do want to ask the panelists now, let's say you do have a concentrated portfolio. What are the best kinds of hedges? Is there anything that's reliably negatively correlated to these things that you can really count on? Should people be buying puts on these stocks? What do you do if you want to protect the downside?
The best strategy that I have seen, generally speaking, as a direct hedge, doesn't cost you money, is option volatility arbitrage. And I don't mean buying tail hedges or buying puts, but there are managers out there that engage in volatility arbitrage. And during declining markets, when volatility is rising, there's tremendous inefficiency in the options market as people clamor to buy protection. You get a lot of inefficiency in the market. So, and these guys don't necessarily lose. I'm talking about the volatility arbitrage guys. I'm not talking about the guys that just buy puts to protect the market, which is decaying every day. I'm talking about the people that are doing correlation dispersion, or various iterations of option market making, things like that, where typically when markets go down, vol goes up. There's a lot of inefficiency and chaos and edge in volatility arbitrage. And some of the people have made tremendous money during years when markets have gone down, and then when markets have gone up, these guys even still tend to make money. At least the managers we've been invested in, it's much less, maybe 3 or 4% during years when the VIX is low and the market's up 31% like it was last year, and then in years like 2008, thinking one manager in particular made like 45% in 08, 70% in 2000. So in years like that, when there's a lot of inefficiency and chaos in the options market, they're able to capitalize on it and then not lose money when the markets are very stable. So for me, that's the best marriage in terms of, otherwise your hedge is just going to cost you money, and degrade from your returns if that's the bet you want to make.
Yeah, I don't like the idea of, there's no natural hedge right now. I think bonds are expensive. I don't think gold is a hedge the way it was before. Writing options is not a hedge. I guess, Neil's option makes sense to me, the way he described it. I just think in general, you'd want to find some kind of non-correlated return stream, whether it's a hedge fund strategy or something that acts, and maybe you have to pay up for that a little more, but there's no sort of simple or simplistic beta hedge approach that makes a lot of sense to me right now, that you'd want to roll on a consistent basis year after year.
Catherine, do you see your CTAs as a hedge, or do you use other things? Or?
Well, it depends on what month you ask me about specifically. So like in March, yes, it was brilliant, right? And then in other months, it was disastrous. In fact, if anything, they had more levered exposure to the same thing I was long in other parts of my portfolio. So I don't see them as a hedge. I see them as a diversifier. And that's a message that I'm kind of constantly trying to reiterate to my board of trustees, that these are not perfect hedges. They are diversifiers. And sometimes they're beautifully negatively correlated, and sometimes they're wildly positively correlated. So, so no, not a perfect hedge.
Roy,
okay.
I think you're an excellent CTA, and you've been around you've stood the test of time. I mean, and that's saying a lot. You've done a great job. you know, when I think about CTAs, I often think about trend followers, right? And maybe it's you or other people have done studies as to explain the return profile of trend followers, which is, I think, the bulk of it, and why it looks like a hedge for equities is because of the long fixed income exposure. And
Yes.
and you know, they've made the bulk of their money by being long fixed income because, you know, often stocks go down and bonds go up as a safe haven, you know, sovereign debt. You know, it's a weird conundrum now because you've got negative yields. I mean, how far are they going to go? Are they going to be negative 3% on the 10-year note? I don't, you know, it's hard to fathom. Again, we've seen crazy things that I never thought would have happened, but it's hard to believe that you know, with trend following CTAs being explained, the return stream and their ability to hedge a long only portfolio being explained by basically their long fixed income book, it's hard to believe that that's going to happen again, although I suppose anything is possible. But I just wanted to throw that out about CTAs being a hedge for the long side of the book. You're doing something very different, which is, you know, obviously I'm sure the audience is aware of that, but just typical trend following CTAs, which was the old school CTA, what you would think about, you know.
Actually, I became a bit of a pariah in the industry, as some of the people in the audience know, because I published a white paper a few years ago that actually computed where that fixed income return came from. And it turned out that 70% of trend following return in fixed income came from being long duration. In other words, the positive roll yield of being long the 10-year, long the 30-year, long the 5-year, and bunds versus cash. Even as rates went down, and you could follow that beautiful downtrend in interest rates since 1990, only 30% of the money came from getting that trend right. 70% was just saying, you know what, the 10-year has a higher yield than the cash, and so it's good to be long that. So, you know, my question is, well, what happens if we hit a rising rate environment? And our conclusion was it's going to be a lot harder. And in addition, the negative correlation goes away because you're not long fixed income enough. And in fact, one of the interesting results we found was that the 10-year futures actually go up if interest rates do what they've done from 1990 to now in reverse. So imagine a rising rate environment for 30 years. The 10-year actually rises. There's no downtrend at all. It actually is an uptrend, not as big, but still an uptrend, again, because of the roll yield. So it's an interesting concept to question. I would be remiss, given the number of shorter term managers that I've seen today, not to have a little plug for those who have spoken before, and I guess we'd be part of that mix as well, that there does appear to be a more consistent relationship in the CTA space among the much shorter term managers to realize volatility and conditions that occur when these FANG stocks and equities in general go down, because that's one thing that I think you pretty much can count on, that realized vol is going to be pretty high if there's a catastrophic or significant bear market. And maybe one more question on this particular topic. What happens if we hit a world where vol starts to go up as stocks are on the highs, which is what we've seen? Or conversely, a world in which fixed income duration becomes a risk asset, which is what we've seen, I guess, a little bit this year. Bonds are not really up this month. This month. Bonds are not really up this month. In mid-March, when stocks were super volatile and going down, we actually saw the 10-year and the 30-year go down also. So in those scenarios, what works and what doesn't? Just any quick thoughts on that?
I just have one quick thought, and I'm just going to interject my opinion. When stocks go down, bond yields will rise this time. Very unusual situation, because I think when the market turns, and I don't know if that's going to be this year, next year, 5 years from now, it's going to be a reining in of the massive liquidity around the world, a reduction of the massive liquidity around the world, and that's going to have both a negative impact on stocks and a negative impact on bonds. Because to think that bonds, you know, with negative nominal yields around the world are not themselves a manipulate, you know, use the word manipulated, use the word influence, a product of the world being awash in liquidity, I think we're kidding ourselves. The whole thing is all about global liquidity right now. So when that tide turns a little bit, if it ever turns, it will turn. I don't know the timing of it, or it could be years from now, I don't know. But I'm confident in the fact that as stocks go down, bonds will also go down, and you'll have this double whammy, and you've got tremendous risk parity positions put on where people are long bonds and they're long stocks, thinking that one is going to be the hedge to another. And you know, the market always finds the ability to screw the maximum number of people the maximum amount of times. So I think bonds and stocks will go down in concert with each other. So I don't think there's any safety in bonds at the moment as a hedge for stocks.
And that certainly calls into question one of the fundamental kind of core assumptions that underlies proper portfolio construction, which is stocks and bonds are a hedge for each other, the 60-40 idea, and obviously on the way using leverage to get risk parity. Asim, Catherine, any thoughts on these tail events of vol and and interest rates and how they might affect things?
Yeah, look, I agree with Neil that you'll see stocks and bonds go down together. You'll see yields rise as stocks go down in the next major bear event. And again, I also agree the timing might not be for a few years. You don't know. The vol thing is complicated. You saw vol rise in a very jagged fashion during the final couple of years of the dot-com bubble. And that didn't necessarily derail either stocks or bonds in that particular time period. But then you also have other things happening today with a very different underlying structure where you have a lot of folks focused on the vol of vol, second derivative, and then you have dealers and desks protecting themselves. And you look at what happens with gamma and all the gamma levels that different investment banks have highlighted. And so you see furious moves that happen far faster and move in a straight line without the typical pullbacks and without the resting spots that you saw when you analyze charts from the 90s or the early 2000s. So one of the things you have to deal with, and this is going to affect a discretionary or a systematic program, is these super sharp moves that can last for 4 weeks or 5 weeks, where it's a move that would have taken 3 months, previously, that now happens in a month or in 3 weeks. And that's the kind of thing that, again, it's partly based on the way that folks are hedging and changing, and even bids being pulled by high frequency traders when events happen.
Definitely. If anyone's interested in that particular topic, it's been well covered on Zero Hedge. So I recommend looking at that if you're curious about how gamma hedging is working. Catherine, any final thoughts on that topic? And I think we should try to take the question in the box there.
No, nothing really to add. I mean, that's another thing that really makes us quite nervous is the prospect of kind of our risk off trade, becoming correlated to our risk on trade. And then what does that do from a portfolio construction standpoint? I don't think there's any quick or easy answer to that.
All right. So I guess if we had to summarize, a good hedge for tech stocks might be all the managers that you've seen today. You should invest in every one of us. Okay. So let's just take one quick question. The question is, is there a scenario where money moves out of the big tech stocks and into, I guess, IPOs or small tech stocks? Like, could there be a size migration that would have some impact on tech within the tech sector, let's say?
I think it's difficult. The amount of money in those big, like even the big 5 to 10 tech stocks, I don't think you can really easily reallocate it within the sector. It would have to be a larger shift, almost to emerging markets or to European banks. It has to be something where these flows can be absorbed. Moving money from Apple, Google, Amazon, stocks that are $1 to $2 trillion market caps, the next 200 stocks can't absorb it. So I think it's a difficult scenario for me to see within the sector, but it could happen. The prices of these things would have to change radically.
So you're saying that the FANG stocks are the Bitcoin of the stock market.
Yeah, I agree with this, Asim. I mean, there's not enough liquidity in the smaller tech names. I think the FANGs have been called the most crowded trade in the world or ever or something like that. And you have such a world that's awash in liquidity. Hedge fund industry has over $3.5 trillion, but it's not even the hedge fund industry. It's the pension funds, the university endowments, state and local governments. I mean, they can't be buying small tech stocks. They have to cover the biggest names on the board just from a liquidity perspective. In some ways, it's an easier job. They don't really have too much to think about. It's just what stocks are liquid enough for me to buy, and I got to own them, and that's as simple as that. And I'm benchmarked, and I got to try to beat my benchmark and my peer group, and I don't have to think too much otherwise because I'm not in the absolute return business. So that's my thoughts on it.
Yeah, and in the favor of the tech stocks, I guess the question is: are there any other randomly chosen 5 stock sets that everyone on the panel, everyone on the call here, does business with all of them almost on a daily basis? So it's they've really done an incredible job, and perhaps they're undervalued by an order of magnitude or more. So with that, thank you, panelists. Thank you, James. And
Thank
I'll
you.
turn it back over to you.